Welcome to Going Long with FCLT Global, the podcast that dives into the world of long-term investing and strategic decision-making, hosted by Sarah Williamson. Going Long features thought-provoking conversations with some of the brightest minds in finance, economics, and business today. Each episode will bring you exclusive interviews with renowned executives, investors, and experts who are driving change in the world of finance, getting their unique perspectives and uncovering strategies that have shaped their success. Whether you're an investor, a business leader, or simply curious about the forces shaping our global economy, join us as we explore the power of long-term thinking. This is Going Long with FCLT Global.
Thank you for joining us today for the Going Long podcast with FCLT Global. Our guest today is Raphael Arndt, the Chief Executive Officer of the Future Fund, Australia's sovereign wealth fund. They manage $285 billion on behalf of the Commonwealth of Australia, and Raph has been the CEO following his stint as the CIO, which followed being the head of infrastructure in Timberland there. He's also the chairman of the investment committee and a board member of the Melbourne Lord Mayor's Charitable Foundation, Australia's largest community foundation. And importantly for us, he joined the FCLT board in July. So, Rob, thank you very much for joining me today.
Thanks, Sarah. It's great to be here.
So we've got a lot of interesting things to talk about, but I wanted to start with the basics for some of our listeners who may not be as familiar with the Future Fund. So, could you just give us the brief summary of the organization and its mission?
Yeah, thanks, Sarah. I'm happy to do that. It's a bit unusual for a developed economy, a developed country that it has a sovereign wealth fund. They tend to be more prevalent in emerging markets or markets with big sort of royalty streams from commodities. The Future Fund itself was established in 2006, and that was a period where, believe it or not, it's hard to remember, Australia's Commonwealth government, the federal government, was more or less able to retire its debt in total. And financial markets got a bit perplexed at this because they weren't sure how they would price other securities if there was no sovereign debt. So they asked the Commonwealth not to retire its debt. And it then made a decision to establish a sovereign wealth fund with a specific purpose. And that purpose was to invest to offset future unfunded pension liabilities that, like many governments around the world, it had not put assets aside against those liabilities. So in 2006, we were established, we were given about a bit over $40 billion in cash and about $10 billion in unquoted shares in a company called Telstra, which was the Australian telecommunications company, which was being privatised at the time. And then there were a few more inflows that year from budget surpluses, which we used to have. And so the Future Fund was established with $60 billion, and I think it's been referred to as the best funded startup in history. And it was quite unique because not only did we have this capital, but and this very long-term mission, but we hadn't any legacy systems, people, or ways to operate. And so the founders at that time were able to do some research, look at other sovereign funds from around the world and think about the best way to invest long-term portfolios, and came up with this approach, which we call now joined up whole portfolio investing. We used to call it one team, one portfolio, and often the industry now refers to it as a total portfolio approach. So the Future Fund itself never got any more inflows because suddenly the financial crisis occurred and Australia went from budget surplus as a team to execute on those strategies, and to support them in the enablement teams meant we had to get bigger. And that was a very investment-led process. And then secondly, we decided really to enable this whole portfolio thinking, we needed to invest heavily in our technology and data capability so that we understood what was in the portfolio across all the different mandates and manager relationships, looking into the private equity funds and even the fund of funds and matching that up with the listed exposures. And so we went on a journey that really ramped up our resources in technology and data. And that meant that the culture was put under some pressure. And it just so happened that COVID coincided with the tail end of that effort. And so most of our people are in Melbourne, Australia, and we had 262 days of being locked in our houses through that period, which we try to forget. And that, of course, frays a culture which is focused on collaboration. So as CEO, one of the first things I wanted to do was really strengthen our understanding of the culture we already had and the one we wanted, and then empower the organisation through its leaders to step up and articulate what that meant in terms of day-to-day behaviours and decision-making, and strengthen that through the whole organisation. And I think the surveys and the feedback coming back will tell us that that's been quite successful.
That's great. That's great. And I think that to your point about so many portfolios are broken up into small pieces and managed against a benchmark on a fairly short-term basis, that they give away the advantages that they have of being long-term or being flexible or being large in some ways. And so getting around that problem, but still having people focused and motivated and engaged and expert and so on is quite a challenge. And it seems like you have managed to put those two things together, but I can't imagine that has been easy.
No, it's a big Sisyphean some days. Like, gravity works against you because people want to control their own destiny and want simple problems to solve, like what do I buy to beat this benchmark? And as much effort we put into getting great people and understanding the culture, working collaboratively, having shared accountability, selling your best assets to fund someone else's worst ideas, which we might think are more important for the portfolio today than your best assets, is not a natural thing. And so we just have to keep working on it all the time.
Right. So coming back to the portfolio as a whole, you have been writing about sort of how you think about this and how the world is changing. And I think also a bit unique in sharing your thoughts with the world about what you see going on in terms of new investment orders and things changing. Can you talk a little bit about sort of why you share those ideas broadly, and then perhaps we can dive into some of the ones that are on the top of your list right now, starting with geopolitics, probably. But first of all, why do you do all this thinking and then share it with others?
Yeah. Why do we stick our neck out?
Why do
Most public funds don't, right? Like, I think the definition of success and risk for people who work in the public sector is quite different to people who work in the private sector. And very often you'll be cut down for taking a risk or being different. But if you just do the same old thing that everyone else is doing and all fail as a group or succeed as a group, you'll be safe. That's not the culture that we wanted. We really think we've got a special opportunity here to make a difference for the country. And we're very, very fortunate because, unlike most people who work in our industry, we have no clients. We have one stakeholder who's very, very sophisticated. So we don't have to raise capital. We have no marketing or business development function. We have no regulator. And we, of course, have oversight, which is through legislation and reporting activities back to the government and the parliament. But it's very, very different to financial services regulation, which I'm sure many of your listeners would work in places where they would be very frustrated at what a regulator thinks is important versus what they think is important. And that diverts attention and resources. And so really for quite a few years, as post-financial crisis, as we went through this regime where there was huge coordinated monetary stimulus across the world, it became very clear to us that could not continue because interest rates were zero or negative, and real interest rates were strongly negative across much of the world, and it made no sense. And so we started to do more and more research looking into historic periods where that had occurred and what we thought might happen next, and started to produce some discussion papers for our board around things like our conviction that inflation would re-emerge, that this wealth transfer to the owners of assets away from people who have to work for a living was unsustainable and unequitable in the long run, that governments were likely to become much more forceful in using their fiscal lever to not just achieve economic outcomes, but probably also societal outcomes, particularly wealth redistribution. And that same dynamic was creating a perception in many countries that external focus for countries at the sovereign level was not a good use of resources. So the most obvious example is the US, but there's many other ones where there's a very strong discussion going on now about what should the US's role be as a global power, not just in military sense, but also in an economic sense, versus what's important domestically. But we're seeing that same thing play out right across the world. And so we started to produce discussion papers for the board long before COVID, several years before COVID, about these things. And then, of course, we had COVID. And so while investment markets were in crisis and we all went home, as I said, it was also pretty clear to me that this would be a catalyst for these type of changes that we'd already been studying. And so we put quite a lot of resource on thinking about the future and about if the world was going to go through a fundamental regime change, why would this be a catalyst for it? And what would the consequences be? And we produced about 30 papers through that period on this topic, quite a lot of detailed work, and basically rebuilt our thinking about investment markets from the bottom up and reset the portfolio so that it would be much more resilient and succeed in this new world. And it just seemed to me that this thinking was way too important to be hidden in our boardroom. We're not saying we're definitely right. Of course, there's a robust discussion and many different points of views, and no one really knows, but I just felt it was so important, a conversation, that we had a role as a public sector organisation to stimulate that debate. And so we published the first paper for a new investment order to really set out our thinking and call for people to debate.
And then you've just published about a month ago an update, if you will, or an addition to that, which really focuses on geopolitics. I think you said in there that the last 30 years was sort of an anomaly, and that we should really think very differently going forward. So, of course, we're the long-term capital people. So if we think, most of our careers have spanned this anomalistic period of the last 30 years, how do you think about shifting that and looking forward to a very different period? Tell us sort of that was then, this is now kind of contrast.
Yeah, so if you go to the first paper, we set out really a hierarchy of thinking about what has changed in economic markets, in domestic politics, but we also talk quite a lot about geopolitics. And I was hinting at this before. When you've got more populist governments, which we're seeing right around the world, and they're responding to their local communities' lived experience, where many, many of our younger people in particular are not that satisfied with their institutions and the decisions their governments are making. They're turning introspective. And this is a pattern, unfortunately, that has repeated through history many, many times. And so some of our research looked back 400-500 years at these cycles of populism and really informed our thinking about what might be coming. And so on the geopolitical side, the world's lived through this reasonably stable period, firstly of the Cold War and a bipolar world where while there was conflict, it was contained because of the fear of that conflict spreading to a global war. And so it tended to be fairly localized mostly. And then a more recent period where the Soviet Union collapsed and the US became the global hegemon. And especially if you're American, it was easy to see the world as totally aligned to your way of thinking, your values, your approach to the world. But the reality is that's not true. And actually most people in the world live under regimes that think quite differently. And so like all empires in history, there's a cost to maintaining that control of the world, and that cost is high. And so it seemed pretty likely that the US people over time would decide that they weren't willing to pay that cost, especially as the memories of what the world was like during the 30s and the 40s and World War II waned as generations move on. And so today we see a world that's much more multipolar, and that continues to emerge. And in a multipolar world, we expect a lot more volatility and a lot more conflict, because there are just fewer controls on local powers from expressing their views through force. And so the point of the paper wasn't to say that we can predict the future, or that we can predict events, or even that we know how to invest in ahead of or in response to specific events. It was explicitly to say we can't do that, but we do see a longer term trend here. And that trend is to a more fractured world where supply chains have to be through friendly and stable countries, not just anywhere in the world. And by the way, the definition of friendly and stable will vary depending on which country you're in when you ask that question. And where more of our societal resources will go to supporting defence and other military activities, and where there's more of a global competition for commodities to support all of those things. And so we see that trend as solidifying at the moment. It's not 100% guaranteed, but it's solidifying. And there's few signs right now that we're likely to go backwards to a more rules-based global order, which we've had for the last few years. And you could debate whose rules, depending on where you come from. And the big takeout, the two takeouts, I think, for investors from that insight are: one, expect a lot more volatility, and that means that a more liquid portfolio is valuable. And you also need to build your own governance and oversight in a way that you can make decisions in response to new information and act on it. And then the second one is almost all of the trends we see are inflationary in some form. Either it's global competition for commodities, for capital, to fund various things, or it's a change in supply chains, a need to reindustrialise or move the capital investment process that forms part of the supply chains. It could be increasing tariffs, changing taxes. All of those things are inflationary. And so investors need to get used to higher inflation and higher interest rate worlds where money is just more scarce. And we've come out of a period through most of our careers when capital actually was pretty available and not that expensive. And we're moving into a period where it is. If you're an existing owner of capital, the adjustment can be quite painful as interest rates rise and discount rates rise. And we've lived through some years like that in the recent past, but we don't think that process is finished. It might be volatile. But actually, once you get through to the other side, it looks much better because you're going to earn reasonably healthy nominal returns and hopefully real returns in that world.
And volatility plus higher interest rates means option value is higher. So you must be sort of thinking about how do you have more options? Is that a fair way of thinking about it, rather than the classic reversion to the mean, lock it in and wait for it to come back mindset?
Yeah, exactly. So I think we've written 3 discussion papers. The second one we haven't referred to yet was something we called the death of traditional portfolio construction, with a question mark. And really the point we're making there is the pervasive approach in our industry since the 50s really has been to have conviction in this reversion to the mean mindset, that asset classes behave in particular ways and correlations, while they might depart from that broad relationship for short periods, ultimately revert back to what they have been observed for the last 60 or 70 years. And therefore, this construct of a 60% equities, 40% bonds portfolio would make sense. And it may still make sense in certain market conditions. So a normal economic growth or recession, business cycle type world, it makes sense to hold that portfolio. But in a world where there's more conflict, where governments are much bigger and more pervasive actors in the economic system, where governments are likely to move into modes where they influence at what price they're borrowing money or how they manage their budget deficits, potentially a world of financial repression, it doesn't necessarily make sense. And we've seen that there are many, many more tools available to investors these days across not just all the private market options, but also various hedge funds and other alternative strategies where you just have so many more tools available to choose where and how you might like to invest. Or even within equities or within bonds, there might be aspects of markets that make perfect sense to you in certain parts of the regime, but other parts that do not. So what we're really saying is you have to be much more thoughtful and granular in how you think about your portfolio construction and what assets you own. And you have to know what you own. And that sort of sounds a bit trite, but for a large, complex investor like us, it actually wasn't that easy to know what you're own when lots of your portfolio is outsourced to managers. And so we've built a system now where we can aggregate everything together and say a single snapshot by currency, economic, geographic exposure, industry, and so forth, across listed and unlisted, across private equity funds, into private equity funds, and so forth. And then we can start to make informed decisions about where to move the portfolio.
And as you've said, the sort of, where you sit matters a lot in some of these questions about geopolitics. And one of the things that I think is different, at least for many investors, is investors have always worried about the politics or the geopolitics of the country that they're investing in, where they're sending the money to. But a lot of countries, including the US and I think Australia and maybe others, have worried less about the politics of where they're investing from. In other words, the geopolitics of where they're investing from. And if we get into this system, I think, as you've talked about a little bit of very bifurcated, are you also thinking about who else could be competing for the same assets? Because you could have a very different sort of marketplace, if you will, rather than a global marketplace for assets. If we really get to the point where only certain people are going to buy certain assets and other people are not going to touch those assets, the pricing gets very different, doesn't it?
Well, I think we're already seeing that world.
Yeah.
So I'll give you some examples. Like if I was an American investor, which I'm not, and I wanted to invest outward into the world, then OFAC already has a very extensive list of companies I'm not allowed to invest in or export my product to, and that list changes very frequently. And by the way, I have to build a whole process to understand the changes in that list and what I'm allowed to invest in or not. And now I have to understand what this small garden high wall policy is, and maybe the things inside that small garden might be quite attractive to invest in if I happen to be American or an American ally. But if I'm not, or if my country hasn't decided yet, then maybe it's quite risky because those investments might be expropriated or I might be forced to sell them. And we've seen examples of that over the last few years across many countries. I think the speed at which the Western Europe and America decided to impose sanctions on investments in Russia after it invaded Ukraine was surprising to the industry. Historically, those sort of actions have taken months or years to get a clear response. And so investors had much more time to reposition their portfolio. And it occurred to us that most people had some sort of exposure to Russia, and many investors, ourselves included, had some sort of exposure that got stuck there. We're not able to sell those positions, but it wasn't material. It was a bit more material for some European investors, depending on how they had their portfolio constructed. It was unclear at that time for a few weeks whether China would support Russia and how strongly they would support Russia, and it was unclear to us whether sanctions would be imposed on China as a result. and we're a much bigger exposure to China at that time. So these are just new risks that we have to consider and price that we didn't really have to think about previously.
Another risk that you have, I think, as a sovereign wealth fund and as somebody in the public eye, is the reputational risk. So how do you also think about sort of your mission, your responsibility, the fact that you're in some ways representing, your home country when you invest? How do you think about overlaying, whether it's geopolitics or in other spaces, overlaying those considerations how do you put that into this whole portfolio model?
Yeah, that's a great question, and it's a really important one. And actually, in our investment mandate, we have an obligation to protect the Australian government's reputation in financial markets. It's actually built into the investment mandate alongside the return and the risk metrics. And so we've had to build a capability of thinking about reputation risk. Of course, it comes not just from the investment program. We make decisions every day about how to operate the organisation too. But the biggest risks come from the decisions we make about where and how to invest, and sometimes by how our managers invest. And so we've put some effort into building our capability to understand reputation risk, because it's quite fast moving and it can change based on the attitudes of the day. And so it's quite difficult to codify and put into policy and process for investment people who tend to want answers like, well, just tell me what I can and can't do. And it's just not that simple. So instead, we work with our team to train them, to work on case studies, and to empower them to elevate decisions when they see something that concerns them. And then we can make informed decisions. And we need to emphasise that we don't have a zero risk appetite on reputation risk. If we did, we'd never be able to invest and would never meet our return mandate. But we need to make understood and known decisions around reputation risk. And it's quite often that when we see a reputation risk, we can change something, adapt something, exclude some small part of the strategy from the business strategy, build in a buffer to help people if we're providing a service that's thought to be essential, where some people might not be able to afford it. How do we think about how we help those people transition to some lower cost option, which don't really impact returns materially, but help to mitigate the reputation risk quite considerably.
That makes a lot of sense. So you've spent a lot of time over the last several years thinking about these big issues. You've talked about a lot of populism, geopolitics, inflation. Obviously, decarbonization is got to be on your list as well in terms of the way the world is changing. What's still in the kitchen, if you will? What hasn't come out yet? What are you thinking about that we should be thinking about next? So, as a long-term investor, are there other things that that maybe a lot of people aren't quite thinking about that should be on the list?
Well, first I would say there's a lot changing in the world. And so I think writing a paper isn't the same as having a clarity of understanding of how that particular issue affects you, and then how you should respond to it in your organisation and your portfolio. And so we still have a lot of work to do internally to ensure that we understand these changes we see in the world and we have clear strategies around them. And in fact, we're going through quite a comprehensive process with our board starting this month and for the rest of the year to go back to the beginning and take them through all the many assumptions and interpretations we've made about our mandate and how we build portfolios and how we see the world and how that all comes together to how we construct portfolios and make day-to-day investment decisions, and indeed how the organisation supports that. And I think having a strong and clear foundation and clear governance around who can make decisions then puts you in a very strong position for a volatile world. So you can change your position and your view quickly and nimbly when things change. If you're not sure who can make a decision, why you do it the way you do it, then it's pretty hard to change. So I think we're putting effort into that right now. We talked about culture, and I think it's sort of a soft thing that people don't necessarily see as an enabler of hard financial performance, but we do. And so we've sort of put a challenge out to our own organisation as we think about our next iteration of our business strategy, which is we think the approach we're taking is working, and we look at our own metrics and we analyse our own performance, and we can always do better. We think it's working reasonably well. How can we be even better at that? And very much, I think we're forming a view that the answer is we talk about being joined up whole portfolio investing. What that means is we have to share our information and knowledge, but also we need quite a diverse organisation who has different views by background, age, training. And so when people have a view that what we're doing might be risky based on how they see the future, then we want them to speak up and call it out and challenge. And I think we're working against cultural norms and societal institutions and expectations. And as our workforce has become more diverse, we have many more people from cultures here who aren't used to challenging authority or speaking up in public fora. For example, people brought up in a Confucian background. That's something that's quite difficult culturally for them. And so we're working on how do we support that and how do we train our leaders to support and lead diverse teams and get the benefits of them. And I think the focus for the next few years is actually more going to be on those type of things, so that we can get the benefits of the system we've built around how we invest.
Well, that makes a lot of sense. You can't have a crystal ball, but you've got to build the team that can react when new information becomes available. The governance, as you said, but also that culture to see the different sides of the story. So a lot of your outlook sounds tough. It sounds sort of heavy. It sounds, quite serious. But are there areas where you do see a sort of a silver lining here or opportunities? Or is this just going to be a tumultuous time that we're just going to have to get through?
That's what I'd say. For most investment people, a tumultuous time is an opportunity. As you said before, it's fascinating. You can learn things, you can explore, and you can come up with new strategies. We can work with our investment managers to find new opportunities and design new things. And so actually that is pretty exciting. And so I think it's important to distinguish between our view being that we're in an inflection point. Many, many things in society are changing. And whether that's a pessimistic view or not. So I don't think we put any sort of value-laden overlay on the fact that we think we're in a regime change, right? That will be good or bad depending on how you came into it, what your positioning and your perspective is. Some people would think it's a great change. So I think our issue is more, if we're aware of it, we can adapt to it. And that's really exciting and empowering for people. We're saying to them, don't just do what you've done for the last 20 or 30 years of your career, do something new. And to the younger people who are joining us, we're saying, what a great time to join us. Now we want your fresh ideas and insights because we might do something different. So that's the first thing. And then the second thing is we're coming out of this period where capital was just not valued. It was really changed. Central banks valued capital so poorly that they actually paid negative interest rates to it. Well, actually, that world has changed, and now there's this enormous shortage of capital to rebuild supply chains, industrial processes, to educate more and more people across the world, to decarbonise our energy systems, to build new technologies to support AI, quantum computing, different types of energy creation. Actually, that's a great time to have capital. There's lots of opportunities. We think we're now in an opportunity-rich environment. So actually, I'm quite optimistic about the future.
That's great. Well, that's a good note to end on, because I do think if you take a that point of view, which is that change does bring opportunity, then I'm sure we're going to see a lot of it. So thank you for your time today. Thank you for your leadership at the Future Fund. Thank you for your support of FCLT Global, and thanks for sharing your perspectives with people. I do think it's a bit unusual, and I think it's really laudable. So thanks very much, Raph.
Thanks, Sarah.
That concludes another episode of Going Long with FCLT Global. We hope you enjoyed our conversation today and encourage you to continue exploring our resources and research at www.fcltglobal.org. If you enjoyed today's episode, don't forget to subscribe, leave a review, and share with others who may find value in Going Long with FCLT Global.